Trading the foreign exchange market carries high risk and may not be suitable for all investors. Trading on margin, utilizing leverage can carry an even higher level of risk that can lead to a complete loss of investment funds. So before deciding to trade the foreign exchange market or using any of our software alert products, you should carefully and diligently consider your personal investment objectives, level of experience, and risk tolerance. There is a possibility that you could potentially sustain significant loss. You should not invest any capital or trade that you cannot afford to lose. It is your responsibility to be aware of and understand all risks associated with foreign exchange trading and to seek professional advice from an independent certified financial advisor if you have any doubts. Avoria Prime does not exercise trading authority over your trades. You and you alone exercise discretionary trading authority over every trade.
So with that out of the way, let's start going through some of the chat. What do you think about the markets overall this week, man? We had some very wild days.
With currencies or just the overall market in general?
Well, mainly effects, I think, since, well, that's where most of us move, I think it would be a good idea to maybe chat a little bit about it, just so people can get our take on it and stuff.
Yeah, we can do a technical breakdown.
There we go. I like that.
Okay, one sec. Let me pull up this chart.
Sounds good, man. So in the meantime, Ryan is asking, would love for it to keep a trade open if running the right direction. Can that be a variable? Yeah, sure. Actually, that's something that we're already working on. Pretty much just a system to where Neo is gonna just aim to ride a bigger movement. Yeah, that's something that we're already working with. Pretty much implementing some sort of trailing stop implementation. And yeah, it just takes quite a while, to release something that's going to change significantly the trading behavior, mainly because you have your typical behavior with Neo, which is pretty much aiming to just get a quote unquote quick profits out of the market. And usually, as you know, the trades last maybe a few minutes to potentially a few hours, and really, really rarely they roll out through a couple of days. So since that's going to change most likely quite significantly the typical behavior of Neo, that's just something that we really need to test out, make sure that it's actually adding value overall, and also, well, that it's that the increase in profits makes up for the increase in risk. Because, well, obviously, if you have a system that's aiming towards riding a bigger wave, then you're also having a small trade-off, which is pretty much cutting the profits off of some of the trades that, well, just happens to be closed right on spot when it comes down to getting out of the trade right before a market turndown, So yeah, in summary, we're already working on that.
There we go. All right, so we have GBPCAD. This is from the daily time frame. So we can basically see that right now we actually came out of this area here that we respected. There was some buying pressure here before. This is the daily time frame, so it is a higher time frame, and we actually moved up into this area. We have a retest of actually areas that were acting as previous support, and if we go down to the 4-hour time frame, we can see where we're at right now. And again, we have previous resistance acting as previous support here. So overall, we were kind of just like in this range for a while, and then we eventually broke out of it. But in terms of the technicals, I mean, dude, the way that this is moving right now, I mean, here's the higher low, the most recent higher low on the 4-hour time frame. Market structure still is technically to the upside. So, finding a level that we actually would have some stick, find some solid support, this looks like it would go back up to the upside. I believe we also have a bit of seasonality for GBP as well, for it to actually gain strength during this time frame as well, which is interesting.
Yeah, man, exactly. And I think in the end, it all comes down to how the market closes this week, basically just in a few hours. See if that some sort of bullish-ish kind of sign candle actually makes up for for the downward movement that it's showing. So yeah, I mean, I think it's the GCAD long term might be finally, breaking up from the from the ranges that it's been with. And also taking that chart and segueing into the performance, which is also an important topic. This is pretty much how the official accounts have been. We're up, let's say, actually, I think I am able, yeah, there we go. So basically, this week has been a pretty nice week, rather slow for the official account, but still pretty strong. We deactivated trading at all yesterday because we did have some major movement right going into the trading window, which is a very unusual behavior. And actually, that's something that's also worth covering as well. So actually, let me pull up a chart and just give everyone a little bit of a rundown, because this is also another topic that was brought up on the community. And by the way, if you're not part of the community, you should join. It's pretty cool in there, and actually you can get a hold of us pretty much every day. If in case you have any questions, or in case you want to, just ask something, that the community is a very good tool to make use of. And actually, I'm just going to drop the link in the chat in a little bit, just so just so everyone can join. Let's see. Let me look out for that. There we go. And actually, I do need to go through the DMs because someone asked me a question saying that they wasn't able to join the call, and that they wanted some questions to be answered. So I sent it wrong. There we go. The link to the community and the accounts is in the chat. By the way, just so everyone knows, in case you want to join, then feel free to join. And going back to the charts, what I was about to mention is that I have some indicators loaded. Okay, let's load GBPCAD. And let me drop to the 15 minutes, which is pretty much, okay, there we go. So our usual trading window starts right around this time of the day. So actually, let's see. Okay, so this is today. We halted trading yesterday, I believe. So let's see. We had the trading window going into, I think it was around this area. Yeah, it was around here. And as you can see here, pretty much we had a very unusual spike. Right off the bat, we had a massive volatility through the day. And right here, if we go through today's trading window, it seems that the markets are settling a little bit more. However, on yesterday's window, as you can see here, this is my local time, by the way. This is not, actually, I'm just going to swap it to the reference time frame that we use, which is GMT +3. I'm just going to pick whatever. I'm just going to pick this one, for example. So here, if we go to the last 2 hours of the markets, you can see here that right a few minutes before we go into the trading window, we had this massive movement right here. And this is the 50 minutes. If I drop to the 5, it's going to be even more dramatic, So yeah, it's something to where we know that NEO doesn't like a lot of volatility. So here you can see that the market started spiking and bouncing all over the place right a few minutes before we moved into the trading window. It ended up a very profitable session. But this is pretty much the types of market movement that we try to avoid as much as possible when we trade with NEO. So if we see that the market is moving around like crazy, that we have massive swings in just a couple minutes, then we say, it might not be a good idea. And let me explain why. Because, for example, this movement was about, if I'm not mistaken, I think it was around, well, actually, let's see. This was around 40 to 50 pips in a matter of just a handful of minutes, which I think it's just enough to get us out for a loss with mode 2. So if we see a day like this and we just happen to pick the wrong side of the market, or well, it just happens that NEO chooses, not the wrong side, actually, let me take that back. Let's say that NEO just trades, in the side where, against where the market is going. Then that means that on average, or well, within that trading day, which is in a typical day, we can see a movement very quickly that's just going to turn against that position. So we just say, hey, let's just not take the odds and turn off the systems altogether. Now, also, this volatility, and actually this also allows me to bring up to do some algo trading talks, this risk also comes out to a big reward, like the trading session where we halted Neo, which I think, I'm not sure if it was yesterday or the day before that. I'm not sure, but still, anyways, I think it was this day. But what I'm trying to say is that when we have days where the risk of having a losing trade is bigger, like, well, that trading session, we also have the advantage of us having a very profitable session, because in the markets, when you take a risk that makes sense taken. When I'm taking a risk, I'm not talking about trading with a massive lot size. That doesn't count as a risk in the market, because the risk goes away pretty easily just by taking away a portion of your lot size. What I mean with taking a risk that's uncomfortable, I mean trading within a day that's odd, trading within a day that's just abnormally high volatility. Actually, that concept goes into Neo very, very good. And I mean, in a very good manner, as just taking a look at the broad logic behind it. We're trading within a period of the day where we see very shallow movement. We're trading within a period of the day where we see very shallow volatility, which usually for big players makes up or turns out to be a big risk for them. We don't know how the London session is going to move the markets. We know that it's a rather quote unquote risky section of the market, just because the market behavior is very choppy and anything can happen to have movements like this. So there we have the risk. Now, that's the reason why the strategy works. That's the reason why we, as peasants, retail traders, have the ability to make profits out of that strategy, because it's not attractive for big players. It does have a risk implicit to it. And well, it makes sense of why the overall concept of the strategy works. The market is very choppy right before market close. It represents a risk because we have the uncertainty about, will the next market open? We're trading right around where the swaps are assessed, and all these factors that just makes the strategy slightly uncomfortable. Not speaking also about the skew that we have, because, well, you have noticed that when Neo makes a profit, it just makes a tiny profit. When we have a loss, well, it's a rather large loss when compared to the profits. So all these factors play a role into why a strategy works, and that actually helps out to answer the question, hey, if the strategy is so good, then why release it? Well, because we know what we have, we know the capacity of the strategy, we know what the strategy can do, what the strategy cannot do, and up to what point we are able to scale it. So it makes sense to, well, just release a retail version of it. Anyways, going back to the charts, this is pretty much the days where we try to avoid trading with Neo, where we see massive movements. Here we had some news events. Here we have another news event. I think it was USD related. If I go to the GBP USD pair, it's going to be very clear what happened. And actually, I think the USD was the mover in that trading session. Let me zoom out a little bit. Yep, there we go. Actually, it was one day before. I was looking at the wrong day. I was looking around here. It was one day before, but yeah. Still, this is one of the days where we see a massive movement. In this case, it was filled by the USD. And if I go to the GCAD, which is the pair that we move or that we trade with, and correlate that, I can see that the movement, actually, it was even wilder than the one that I was taking a look at. As you can see here, we had a massive spike, then we have another massive spike, another retracement, and just the market was all over the place, right? So these are the types of trading days that we just don't like that much. Yesterday's session, which was this one, was reasonable-ish, just because the market movement wasn't that steep, now that I remember. But yeah, generally speaking, those are the trading sessions where we say, it might not be a good idea. This one, we just decided to hold because it was filled by an instrument. So, and also right here, you can see that right around, market open for London, we had some more news events. The market shooted in one direction, and these conditions that we tried to avoid. Yesterday's trading session was a little bit more calmer. We didn't had as many fundamentals for it, so we decided, it might make sense to trade today, speaking of yesterday. So yeah, that's the overall outlook of what we do, what we take into account, what are the factors that we consider to decide whether to run NEO or not. And yeah, I just hope that this small crash course, so to speak, was useful for everyone to understand what goes into making the decision of shutting off NEO or not. And Ryan, by the way, yeah, it was Halton on Wednesday, not Thursday. I was messing up dates, but still, the market movement was about similar. The thing is that on yesterday's movement, it wasn't fueled by fundamentals. On Wednesday movement, it was fueled by fundamentals, and it was reflected all over the place. I mean, it was reflected on gold, well, pretty much all the major pairs that had the USD in them. And yeah, it was a pretty major filled by a pretty major news event. That's why yesterday's sessions we thought, well, it's good to go. And Wednesday we said, better not take the odds because, once again, it was fueled by a very sounded, thing in the markets.
Fernando, theoretically, the original question was like, hey, can we increase the amount of profit that's going to be able to be taken? And that was the original question, right?
Yeah, I think I went through it right before.
Or two questions ago. But what I was thinking is, so obviously that question, the reason for asking is like to make more profit, right? That's the reason for the question. So that's
exactly
one way to make more profit. The other way would be to actually have like the portfolio approach, or have like different strategies, and you don't like, and I think that trade more shit is a good line. That one did stick with me, but I know for myself, like rather than me only trading one instrument and trying to find like a setup every day, I could look at 3 instruments, and then maybe 2 of them have setups, the other one doesn't, or whatnot. But that would be the other way to go. We I guess updates on that though, we're still waiting, right? We're still waiting to do anything with it, but that is another way to make more profit. Would you say in your eyes, would that be a safer way to go about it than trying to max out one system on one instrument?
Completely. And the thing is that there's only so much you can do within one pair and within one strategy. So if you start, as you said, applying the good old TMS logic of just trading more stuff, that way you can just diversify a lot when one strategy doesn't seem to have, or doesn't seem to be going into a good setup, so to speak. Mm-hmm. Then you have other strategies working your way up. The only thing is that to add, more stuff into a strategy, you can think about it as a chain. And I really like that analogy, so let me just do a quick drawing in here. So pretty much having a trading portfolio is like having a chain. Obviously, you have your chain, you have your links to that chain. And if you're adding more to that chain, or if you want to make it stronger, you need to make sure that each of these links is strong enough to hold the entire pressure. Because the thing is that if you just want to make your chain longer, but you don't pay attention to make your chain stronger with it, what's going to happen is that you're going to have a very tiny weak link in here. And if you have that tiny weak link, it doesn't matter that you have massive fancy material strong chains down here. Let's say that this is titanium, palladium, whatever, but this one is just plastic. The moment where these chain starts going into pressure, the very first thing is going to happen is that even though all these links are strong, all these 2 other links are strong, just because this one link is plastic, the whole chain is going to break apart. And it doesn't matter that the rest of it is strong, just because one of them is weak, then the entire thing is still going to fall apart. Mm-hmm. And yeah, the entire system is going to fail. That is, let's say that you have a portfolio of strategies. Let's say that you have strategy 1, strategy 2, strategy 3. You want to diversify, so you just rush the process, and that strategy 4 is going to be your weak link. And then you have other strategies, let's say 5 and 6. It doesn't matter that 1, 2, 3, 5, and 6 are making profits, making a killing. even bringing you up into a few double-digit months when it comes to the profits. I mean, as far as percentages go, if this strategy is failing to the point where it's a weak link that's so weak that puts the entire account at risk, then just because of this weak part or weak piece of the equation, you can end up blowing up your account, even though you have other five strategies that are making a profit. You can blow the account up with only one that's not making a profit. Obviously, this is a very exaggerated example, but that's pretty much our thought process when it comes to adding more stuff to Neo or adding more stuff to a portfolio in general. We have one that's very good. If we're going to add a second, it needs to be as good or better for it to pass or filter and say, okay, this is worth adding to the chain. I'm comfortable adding this piece into the equation. And I do have the trust in it to where I'm rather sure, maybe not that it's going to make a profit because, well, the markets can do whatever they want. But we have at least the peace of mind that according to the testing that we've done, it's strong enough to be on pair with what we have right now, so to speak. I'm not sure if that makes sense.
Yeah, that makes sense. And I guess it just depends on, the strategies being implemented. Because if you do have a strategy where the potential drawdown in a single trading sequence is 50%, then if you roll the dice with 4 or 5 strategies and each one has a
Yeah,
drawdown of 30, 40, 50, you do the numbers, it's like 30 plus 40 plus 50, right? That's your potential risk. And then if you had, other strategies where, I mean, let's just say hypothetically, the worst case drawdown was, 10% or whatnot, and the average gain, so it just really depends on the average potential risk and, the type of strategies that you're adding on, I think.
yeah,
And,
exactly.
and it doesn't, there definitely is a point where, especially like as individuals, like in the amount of capital that you have, there's a point where, when you add on too many, you're just not able to do the proper risk management to like really even handle different trading strategies inside one portfolio, especially if you're
Exactly.
using any type of cost averaging for your entries. There, you just want to make sure that you can do that and withstand, whatever the worst case scenario looks like for those. So maybe it's a 2-month period of drawdown. I don't know.
Yeah, exactly. And also that involves, being able to understand really well and to know really well what's your strategy and to really understand what are the strong points or the weak points about your strategy. That makes a huge factor into building that portfolio. And actually, just thinking or well, speaking out loud, that's the reason why you have hedge funds, banks, and all these massive institutions having access. I mean, there's always this chatting or this thought process, behind hedge funds, behind banks, and all this kind of like a magic to some degree lore that goes around them and saying, hey, banks have access to strategies that retail don't. Hedge funds have access to strategies that we as retail traders don't have access to. And it's to some degree, it's not because we can't trade those strategies. It's actually because of what you mentioned right now. It comes down to a point where you have so many strategies that each of them has such a small risk piece into it that you need a massive account to be able to make some sort of the minimum bet size, on each of them to maintain a reasonable risk level. Think about it this way. Let's say that you have a strategy that requires $1,000 to run. Then $1,000 is the bare minimum. You add a little less to that, and you are outside of your risk parameters. Let's say that you want to run another strategy under a similar setup. You can't do that because all your capacity or your load is maxed out within one strategy. Picture that you have 20 strategies like that. Then very quickly you start needing to have, or you start in becoming in the need to have a 20K account to run it. Let's say that your minimum.
To put it into perspective too, when I was living in Tulum, Mexico for a bit, I met a trader that actually traded at a bank. They do like, I don't know what the exact percentage is. I know that there's a good percentage of institutions that are moving into, quant analysis, and, they have tools to look at data that, your average trader doesn't have. It's actually pretty fascinating, the type of information they do have access to, like years and years of data. But anyways, this guy worked at a bank, and I was like, yeah, so what kind of position sizes are you dropping? He's like, like, what do you mean? Like, what was my biggest last year? Like, I was like, yeah, I mean, I don't know, just what are some good ones? Like, he's like, I mean, anywhere from 50 million to 150 million on a position. And the thing that was interesting, and I'm sure that they have different types of traders and obviously different strategies like we're talking about, but what he was doing specifically, and he did trade currencies, what he was doing specifically was actually his analysis would be from the monthly time frame, monthly, weekly, and he was actually holding on to trades for 2-3 months. So it was more of a swing trading deal, but that's why, like, for those of you that are maybe doing some technical analysis, you do want to pay attention to those price points where on a daily, a weekly, you see a spike in like people buying at that price before. We can't make the market. Well, I know that there's meme trading now. So a lot of people are pumping coins, but, as far as I know, to move like currencies like that, it's difficult. And retail traders aren't necessarily trying to pump currencies like they are, cryptocurrencies or stocks. And we have the meme revolution, but we can't do that. We're not necessarily doing that, so that's why it's nice to think with those areas in mind.
Yeah, exactly. It's just pretty much, think about this. If you see a shark or let's say a whale in the sea, you oftentimes see little fishes, swimming, around that big fish pretty much. And that's our goal as retail traders, try to be around them instead of trying to be against them, because there's very little that we can do against, let's say, a big shark being just a little tuna, so to speak. But also, if we learn to try to, obviously there's all these concepts and all these kind of like magic vibe that people give it around, trade like the banks, trade like the hedge funds. Obviously, we can't do that because we don't have near a fraction of the capital that they have to deploy into a single trade in our entire account, But still, if we learn to identify not what they do, but how that reflects to the chart, we can get a clue about what they're doing. And that way we can take that into account to just use that information to the best purpose. So if we learn that, obviously we can't predict what they're going to do. That's why they're a big player, obviously. But we can learn about what's the effect of their moves into the markets. Let's say that we learn to identify, just talking a little bit of TA, for example, Wyckoff. The Wyckoff methodology is a very good method, in my opinion, to learn what's the footprint that the big players leave in the markets, to identify, this is a big movement area. I see certain chart patterns that suggest that a big player is just building something. Then you can use that information and say, I need to really pay attention to this, because that something big or that a big movement might happen, not because you're predicting what they're doing, but because you're reacting to the signs that they leave on the chart about what they are up to, pretty much. So yeah, it's a very, very interesting concept. And actually, let me use this question to segue into one offline, so to speak, question that I got from someone in Telegram that said that his name was Steen. And he said that he wasn't able to be on the call today, but he still wanted to have this question answered so he can watch the replay later. And the question is basically, how would lower volumes on GBPCAD during summer holidays, ranging from a few weeks to a few months, affect NEO trading when it comes to drawdown and win ratio? And actually, that's now speaking of trying to mimic what big players do. That's actually the reason why we make, or why we have NEO tested, or why we tested NEO within such high amount of data. We have testing data that comes all the way back to 2006. We're talking about 16 years of data. And some of you might ask, well, the market is very different if you compare 2006 from now. And yeah, that's true. We're not aiming to build a strategy in 2006 and deploy it in 2021. That's not the purpose. What we're aiming to do is build a strategy that can withstand the movements and still come out at a profit at the end of the year in 2006 and in 2015 and in 2020, because there's always these massive change in market behavior. We have the GFC back in 08, 09. We have the initial Brexit vote back in 2016, 17, I believe. We have all these sort of oil crises, or these old massive behaviors, that fundamental market behaviors that have been happening through the years. And we're not trying to make it, oh, we want to make a strategy that works good during the GFC. Obviously, we don't want to do it because, well, it's something that already happened. It's not worth it for us. But we want to make a strategy that we can see data for and see, oh, this strategy worked pretty nicely during the GFC. So that's a good sign that the strategy is robust, because we see how it behaved during that time of during that period in time. We can see how it behaved during the Brexit vote. We can see how it behaved during the pandemic. And all this data helps out to understand, for example, going into the question, how the strategy behaves during holidays, during periods of low volatility, because all those instances are included. They're included in a very large amount. Obviously, we have 15 years worth of holidays data. That just taken into account within the backtest, and we just see that, well, the strategy seems to be holding up pretty nicely. Obviously, the fact that a strategy makes profit in the backtest doesn't mean that it's going to be a successful strategy. But if it comes out to be a robust strategy on paper on a 15-year backtest, it does have to some degree a higher likelihood of being a successful strategy when compared to a strategy that backtests good within 5 years, within 2 years, or just something that you have the idea that it's going to work, but you don't have access to resources that are going to back you up, or that are going to back your assumption up, right? So the fact that we have a massive data, or a massive amount of data, that makes it to where, well, we see that the strategy seems to be behaving well, just on an overall, to some degree, all-terrain sort of a thing. It doesn't mean, once again, that it's going to keep making profits into the future. Markets can change. Markets can do whatever they want. The markets can make and break a strategy at any given point. That's what I'm trying to say. So a big amount of data, a backtest that goes back a bunch of years, doesn't guarantee a strategy to be successful, but it gives you more insights about the strategy quality, the strategy robustness. So if it's been tested through the last 10, 15 years, it does have a higher likelihood of being a successful strategy into the future than if it has tested through the last 5 years, or the last 2 years, so to speak. So yeah, that's kind of like my thoughts on that. I'm not sure if you want to add something, buddy.
No, I agree. I agree. I mean, I think that the main thing to keep in mind is just a long-term outlook on your portfolio. It's
Exactly.
just like that's it. And it is something that from a social perspective, like people are kind of preaching, let's get rich today.
Yeah.
So, we just want to have a long-term outlook as much as
Exactly.
possible.
Yeah, completely. And the thing is that, once again, we go into that. I'm going to take that saying from the equities market, for example. There's always these speech around timing the market beats timing the market. And that's very true, because the thing is that you can have a really good time day trading. You can outperform the markets pretty easily day trading if you have a 5K, 10K account, because, well, making 50% profits, it's making 5K, which is well within the market capability. But if you're looking into something that's going to compound and take you into the millions with time, obviously one thing is saying, oh, I'm going to day trade this stock and make it to where I'm going to double $2,000 account. Well, that's within the realm of the possibility, because doubling that account takes $2,000. But if you have a 10 million portfolio and want to do that same logic, it might even happen that there's not enough shares available for you to make that move. And even if they were, it makes it to where you're risking your entire $10 million into one single stock, you know? And that's why if you diversify, invest into a bunch of stocks and going indexes, going to, index funds or track some market indexes and just invest in the broad market. Yes, you're going to have a boring time. You're just going to drop some money. It's not going to be exciting, but trading is not meant to be that way. You're just cost averaging into the market. So if the market goes bad, then you don't care. You're still investing. You have your chunk or your investment pretty much just built with time. Now, when it comes to algo trading, it's a similar perspective. Time with a strategy beats timing a strategy, and actually, that's something that we've seen happen with Neo. We have I think it was well over 30 days. I think it was like a 60-day winning streak where we didn't had a single losing trade in a very long time. People were having an amazing time. A lot of people were excited about it. Then a losing period came. We went into some drawdown. Some people bailed out of Neo, and then we just held to it. Okay, this is a normal. That's actually also why we think it's very important to know your strategy, because if you go into a bad period, you know what a bad period looks like and what you can expect from it. So we just said, okay, well, it's a drawdown period. It happens. Let's just go through it. We went into it. We came back at a profits. We are now at all-time highs in the accounts. And then there are some people that are saying, oh, how Neo is doing. And then in the chat is like, well, making profits. I mean, we already recovered from the drawdown period. And they just say, oh man, I wish I just kept kept running Neo, or that I just still had Neo running on my account so I can be at all-time highs again. And that just makes me kind of like go into the thought of, well, then the same applies here too. I mean, we have a strategy that seems to be profitable, that has proven to be profitable to what the markets are doing today. And well, time with that strategy beats timing that strategy, and that's just that concept. Even though it sounds simple, it might be a little hard for a lot of people to understand just because of that, just because of get rich quick speech that goes around trading. People trying to look out for, oh, I want to make 10%, 10% a week. And I'm like, well, I want to do that too, man. That compounds to a very high number at the end of the year. Once again, it's just a concept of overall long-term thinking. Because if you stick to that strategy within the years, 1, 2, 3 years down the road, it's very possible that you're going to be at a very good profit. If you just try to double your account every day, yes, you might have success. Yes, you might make a bunch of money. But once you blow your account up, it doesn't matter that you're in a 10,000% growth. If you build it up, you don't have access to that growth again. I mean, the account is blown. It's gone, So, yeah, it's just having or trying to have that long-term thinking, trying to have that, okay, I'm not going to worry about a losing a week, a losing month even, because that can happen. Any strategy can have a bad month. You just need to switch that thought process into how my year is going to look like, how 2 years from now is going to look like. And that's kind of like the main thought process that we really want to have people aim, or that we really want to aim people to have when using Neo. That it's not a get rich quick. It's not something that you're going to use it today. Tomorrow you're going to have a $10 million portfolio. Well, that's most likely not going to happen. We really want to stress that Neo is just a long-term strategy. It's something that's going to be building up. It's going to be making a few percentage points a month. Well, it's not going to make it. It's what we think it's going to make according to past data, and that doesn't mean that it's going to keep having that performance, but it's what we've been, seeing, just having some constant performance, having some red months here and there. But that's what we can expect from it based off the data that we have. So why we would be worrying about one stop loss? Because, well, we know that can happen multiple times. So we just got to stick to it. Obviously, we as the developers are keep making improvements, keep improving the tech. Actually, as Ryan mentioned, that's something that we're looking into how to implement. If it's going to be through a stop loss management, when it comes to the trailing stop part that he was asking for, we're just looking at the implementation side of it to make it, to see how or what's the best way to do it. We are the ones taking on the load of making the strategy better and better, adding more pairs, adding more diversification to it. Then on the investor side, we just gotta keep with it. I mean, we are building the tech. We gotta trust it. You know, it doesn't make sense to trust or to trade a system that you don't fully trust. So you can just stick with it. I mean, we do our due diligence to make it robust, to make it relatively stable, as much as the market allows. Then it's also on. I mean, that's our investor. That's our developer. That's developer Fernando. That's developer Nick. That's developer Robert. Now, investor Fernando, investor Nick, investor Robert also needs to stick with that strategy. We made the work of developing it. Well, we might as well just stick to it, because it's been a massive work into it, and we know what this can do. We know what the strategy can't do. So we just use that information to the best purpose that we can. So, and segueing into a few questions, Heno, actually, speaking of knowing a strategy, Heno is asking, hey, where can I learn about the inputs? Where can I learn about what each button does, so to speak? There's in AP Academy, there's a video called Deep Dive Settings or something like that. That video is gonna have a very thorough explanation about what each input does. So yeah, if you wanna check it out, then it's on AP Academy, and there's kind of like the full explanation on each video, on each setting. I'm sorry. So actually, CJ is asking if we had the Quant Analyzer report for Neo. I can get a hold of Robert and make that happen next week. I don't have the files on my computer. It's on Rob's computer. So, and he didn't join us today. So yeah, I'm just gonna get a hold of him, and that way he can share that info with us. And also, Henry's asking, so you're saying that when my account reaches 100K or $10 million, it's not gonna behave as other people's account who have 10 and 5 to 10K? No, I was having that example just as a kind of like overall concept. Neo does have a pretty big capacity. So a 100K account, a $1 million account is going to have the same behavior as a 5 to 10K account. Obviously, the rate at which the lot size are going to be increasing is going to be way faster in a $1 million account because, well, you're pretty much compounding on a trade by trade basis. On a 5K, 10K account, it's going to take a bigger trade amount to get the account big enough to increase the lot size one more step, so to speak. So the rate of increase in the volume is going to be faster, obviously, on a bigger account, but the trading behavior will be the same. So yeah, that's the example that I was making is that you can have a strategy that's going to be maxed out and not able to double an account at $1 million or $2 million, but it might do it at $100, $200, $300. That was kind of like my thought process, but I wasn't referring to Neo. I was referring just to a generic example. So, and CJ was asking if I can repeat the report stuff. Yeah, I don't have the reports on my computer. The reports are on Robert's computer, and he didn't join today. So I'm gonna get a hold of him so he can share that info again on the next call. So. Yeah, that was rather a mouthful. So if anyone wants to add something, if you have another question, you can drop it in the chat. If you have some thoughts, you can drop them in the chat or on the Q&A panel. And CJ, for sure, man, no worries, I got you. And yeah, that's pretty much my thoughts on all these algo trading space and whatnot. So yeah, Nick, do you want to add something, buddy? We're kind of like getting close to the hour thing on the call.
No, I think it was a good session. We covered some good points, and yeah, we basically have a few minutes left, so we could probably just wrap it up here. I think we got all of the questions.
Sure. So, actually, if someone has a question, drop it on the chat, and kind of like on the chat or in the Q&A. We're gonna maybe just chat a little bit for a couple of minutes, just in case someone is writing or something. And if not, we can just wrap it up around here. But yeah, man, I mean, as you said, it's just something to where we really want to move away, so to speak, to the get rich quick, thought process behind it. Because, well, as you know, man, I mean, there's a lot of kind of like lure around it of IG ads or Facebook ads that say, oh, this kind of like secret sauce is gonna make you a millionaire in one day, and it's only $3.99, buy it now.
Yeah,
it's just, yeah. The whole concept of get rich quick can happen, obviously. you can have luck. You can have a 1K account, make that 100K, and just realize just in time before you blow it that it's not sustainable, and you get to keep that. So it might happen, but the odds of that happening are very, very small, and the odds of that being sustainable are even smaller. So yeah, it's a process, as you said. Henry is asking, once, for example, an account, let's say that someone has a $10 million account. Will there be any reason to split the account into multiple smaller accounts, so the trades can be smaller, and the portfolio is able to get the trades executed more likely, or if it's basically he's asking if you have a big account, let's say $5-10 million, if it makes sense to split it into multiple smaller accounts to get around, let's say, liquidity issues or slippage or even broker's side stuff. And if you get to that point, yes, I would split the accounts into multiple small accounts. Maybe not because of the capacity of Neo. Neo is designed to handle even, let's say that you want to trade a big lot size and the broker is maxed out and they can't process an order larger than X or Y, a lot size amount. Let's say that that's the case. Well, Neo is designed to get around it, split the trades. Let's say that Neo wants to trade on a 500 lot trade and the broker only allows 100 lot trades. So it's going to split the 500 lots into 100 lots order each. But obviously, we're talking about a lot size to where liquidity is also going to become an issue. So, either way, splitting the trades helps Neo, to just try to get around it. But the splitting part comes mainly through a tech standpoint, because MT4 is only able to handle only so many trades at once. And let's say that you get to the point to where you need to have 10, 20, 50 trades just to get one position build up. Then MT4, I think, allows up to 100 trades active at the same time. So you're going to be maxing out MT4, not the strategy itself. So it makes sense to split your funds through different brokers, and also because the Forex market, it's not like equities. In the equities, you have central exchanges, you have a central place where everyone can see the liquidity. FX market, we don't have that. We have multiple liquidity providers, we have central banks, have massive interbank networks that just have different liquidity sources. So there's not such thing as a central liquidity provider. That would make a big issue, because, well, all the liquidity is tied up within one place. In the FX market, the liquidity can be accessed through a bunch of different liquidity providers. So if you have a big portfolio, it makes sense to have, well, some funds in one broker, some other funds in some other brokers and stuff, because it's likely that each of them are going to use different liquidity providers and that your orders are going to be routed through different networks, so to speak. So that way you can also get around liquidity issues. So let's say that there's only 300 lots available at any given point on one broker. Then you take those and you go into another broker and take, let's say, another 200 and so on and so forth. And that way, well, once again, you start you can start solving that issue. So those are the thoughts, I think. So yeah, we're very close to the hour. Any closing thoughts, Nick?
Yeah, we'll see you guys on here next week. If you do have someone new that you've invited to actually utilize Neo, it is beneficial for them to actually jump on here, ask the questions that they have, and just make sure that it's all answered. And, that'll just be the best thing for them. So make sure to let them know about these calls on Friday, 7 a.m. PST.
There we go. Cool, everyone. Have a really good Friday. I hope that everyone has a really, really good weekend. And see you guys in the next weekly call. Have a good one, everyone.